Oh my gosh, I think the banks are blatantly lying to us about the data that they just reported in their financial releases about the state of the economy. And it could mean the economy is actually on much more of a brink than they're letting on. This is really bad, and ordinarily I would think, I don't know, maybe I'm just reading into this too much. But then I come across, as I'm doing this research, I come across a headline from 34 minutes ago. Jamie Dimon finishes up his 1 million share sale of JP Morgan shares. So 1 million shares, that's like $180 million. And then I'm like, okay, well, that's fine. Maybe he's just taking some tendies, right? I'm sure he's done that before. Wrong. This is actually the first time that he's sold since joining the bank 20 years ago. He has not sold any shares in his history. Instead, now, in February, he sells 820,000 shares, and he just sold another 180,000 shares. Oh, man. What's happening? Well, in this video, I'm going to break down exactly what I think is happening, because at first, don't get me wrong, I go into this, I'm like, come on. We've got GDP that's like 2.6% according to the Atlanta Fed. Job numbers are coming in good. Things are looking okay, Kevin. Listen, Kevin, just this morning, we had fantastic retail sales numbers, okay? And I covered them. And I, too, this morning wrote, wow, what a blowout. This is really interesting. I literally wrote it. Here it is. Blowout. Big beat. All of the numbers came in higher than expected, and the previous numbers were revised up. More commentaries now appearing about the no landing economy. Okay, great. But then we edit in the inflation adjustment later in the day. We know these aren't inflation adjusted, but I go in later and I'm like, let's compare these year over year. So I look at the year over year numbers. I'm like, motor vehicle parts are only up 1% in retail sales. I go, wait a minute. Inflation right now is like 3.5%. That means motor vehicle part sales are actually down 2.5%. But wait a minute. Motor vehicle parts are part of CPI inflation, which has been skyrocketing. Motor vehicle part prices have absolutely been skyrocketing. To some account, they're up 40%, where wages are up like 18%. It's crazy. So why would they say that retail sales are only up 1%? Oh, well, that could simply be explained by people being able to buy less because they have less money. So you didn't actually get a 1% year over year beat. You got 1% minus 3.5% inflation. You're at negative 2.5% retail sales for motor vehicle parts, despite prices being up way more than wages. Same thing for furniture, building materials, and every single year over year category in the retail sales report. The highest category was miscellaneous retailers like pet stores, and they were up 2.5% or 2.7%. Also negative when you adjust for inflation. So then I'm like, okay, wait a minute. So we get it. Like, sometimes the numbers are presented in a cooked manner. Is this really a big problem? So then I put my hat on and I go, okay, well, are we ever negative on retail sales for a longer period of time? And the answer is yes, we are. We're negative on retail sales in recessions and now. Oh, okay, well, that's not great. Then, of course, we have gold at 2,400, which some people have been saying is snuffing out something bad coming. After all, T.S. Lombard suggests that gold 3x'd in 2 to 3x'd in 1972, 78, and 2008, skipping the dot-com recession. Okay, that's not good. So wait a minute. So we've got retail sales numbers that are a little fugazi. The banks are lying to us, which I'm about to get to. Gold skyrocketing, which could be because of geopolitical issues. The Iran-Israel issue is a problem. That could also potentially explain what's going on with inflation expectations, but we have not had an Iran-Israel problem all year. We've had an Israel-Gaza problem all year. But look, since January, inflation expectations have gone straight up. We're on the 5-year at 2.57%, and we're peaking. We are skyrocketing. And so the question is, how long can Jerome Powell keep up the charade, the BS charade, that inflation expectations are going to remain anchored? Not to mention the inversion last year of the 2's 10 curve led to a lot of pain in the stock market. Okay, but this is where a lot of people go, but Kevin, listen, Kevin. I already went to metkevin.com/life and I got my life insurance in as little as 5 minutes. I already did that. The reality is, Kevin, Inflation just doesn't matter anymore. Rates, they just don't matter anymore. Earnings are so Gucci right now. Everything's fine. We don't have to worry about pricing and rates anymore because we're past that. And this is an idea that we've actually brought up this morning. We're like, are markets just ignoring rates? And is that healthy? I mean, since December, in December, we're like, oh yeah, markets are pricing in 7 rate cuts. And now we're pricing in 1.5 rate cuts. And the stock market's been mostly flat. Well, until, of course, today. See, today we broke the 50-day moving average, and we broke this long 6-month trend we've had on the S&P 500. That's not great. Neither of these are great. We're topping out on BTC, the Qs, AI chips. We're topping out on the S&P 500. Everything's topping out. Right at the same time, we're getting potentially, in my opinion, it's just my opinion, straight up fraud from the banks. And the banks lead earnings season. So my question is, what happens when earnings all of a sudden aren't actually that good anymore? And at the same time, Jerome Powell finally goes, yeah, this is a problem. Well, I'll tell you what happens. All of a sudden, the market's going to go, interest rates matter again. Well, that's not going to be good. That's not going to be good. And that's not going to be pleasant. It's not going to be pleasant at all. But why could it possibly happen? Why would the economy have a problem? Well, a lot of people have been asking me about von Mises lately, the Austrian economist, Ludwig von Mises. German, well, he did all his writings in German, so this is a summary. I've been reading primers on Ludwig just to catch up. What I always like to do is I like to read. I read a lot of things, and then you got to come back to it because you're going to forget. So I'm like, all right, let's break out the text again on Ludwig, and then listen. I just want you to listen to this. Okay, I'll put it up on screen, but just listen to this, and then we're going to get to JP Morgan and the disasters of the banks and how they're lying to you. Okay, listen to this. All you have to do is listen. When the quantity of money in circulation, like inflation, rises for some reason, people feel richer and spend more, like stimulus checks. But this extra spending nearly drives up prices, leaving nobody better off. Such is the story of inflation. Mises and his colleague, Frederick, saw that maybe it was actually worse than that, though. Spending booms and these sort of inflationary booms actually lead entrepreneurs to believe that there's a real increase in demand for their products. Tesla. Meanwhile, the surge in credit makes loans cheaper. So entrepreneurs borrow more to invest more and produce more. But this is mistaken overinvestment, known as malinvestment. Malinvestment, which is based on false price signals. And before long, the public spending spree is curbed because things are too expensive, like auto rates, which are absolutely insane right now, and auto loan delinquencies are spiking at an increase of over 7.5%, at least per the New York Fed. That's like 7% annualized right now. But anyway, by printing money, governments can create an artificial boom. But this must inevitably be followed by a bust. A painful adjustment process takes place as malinvestments are liquidated. Ooh, that doesn't sound good, but wait a minute. Like, things should be okay, right? I mean, things are getting better, right? The US has been resilient. The UK is growing out of recession again. Germany's industrial sector is growing again. Bloomberg GDP forecasts are at about 2.9%. China's showing signs of rebounding. Things seem okay, right? Okay, that's true. Things seem okay on the surface. But what if we start looking under the hood? Well, we don't want to look at government interest payments because those look horrible. But let's scroll past that and let's just go to the chart that has government interest payments as a percentage of GDP before we get to the bank disaster. Oh, and that's more normal. Oh, wait, but there's a problem with this chart. And see, identifying problems like this are the kinds of things in perspective, as well as what you're about to learn about the banks, that I teach in the courses on building your wealth. If you're not part of those yet, we have a coupon expiring this Friday. You ought to be part of them. We're releasing new lectures this Sunday, great new content, and in the Stocks and Psych group, you get all my buy-sell alerts when I'm trading. This morning, we came up with some pretty solid strategies on how to trade for the day. Now, I wasn't perfect with my trading exactly, but we had about 1,000 course members watching this morning as we came up with a strategy, said, look, here's the game plan. Here's what happens if Israel does this. Here's where to go if Israel does this. Here's where to go if Iran does this. Came up with a game plan that, if followed perfectly, would have done very well today. Now, what do we have over here? This chart only updates annually. So we don't actually get an update on this chart that's skyrocketing on interest payments by the Fed, the federal government, as a percentage of GDP until guess when? Next March. Crap. Well, if next March we're in the middle of a recession and this number over here is like way up here, what good does that do us as a leading indicator? Nothing. It does nothing. Okay, but Kevin, you've shown us before that consumer debt service payments as a percentage of disposable personal income are stable. They're not actually way higher at like .com levels. They're higher than or at the highest points where we were pre-COVID, but they're not like at extreme levels, right? Like the mid 80s. That's true. But what screws up this chart? Remember, this is a chart on consumer debt payments as a percentage of disposable income. That's a way of basically saying, if you have $100 left over after you pay your rent and your food, and then you have $10 of debt, you're at 10%. All right, that's the money you have left over. How much is going to debt? Right now, we're sitting somewhere around 5.7, 5.8%. Just to explain that. What could change that? Well, if your $100 goes to 50, then that doubles. Well, what's been the trajectory for January, February of 2024? Oh, that's not good. Now, you can make the argument that this real disposable income level is just being affected by inflation, but then it should have been affected by inflation here. And you can make the argument that maybe we're just going back to levels where we previously were, but it's the trend that's the concern. We're about to go negative again if this trend continues. And what if we don't inflation adjust it? Because inflation numbers came in a little hotter in Jan, Feb, right? Okay, don't inflation adjust it. Crap, the number's going down as well. Nearly straight down as well. That's not great. And it leads into what we're seeing at credit card delinquencies, which this only updates quarterly, but we're way higher than where we were in the 10 years before the pandemic. We're going back to 2024 levels on credit card delinquencies here. Okay, so then I thought to myself, but that's all old data. It's all like Q4 data. What data is going to give me some juice about the trajectory of things going forward? No, it's not Q4 auto loan delinquencies where the Fed's telling us, we're seeing 8.5% of credit card balances and 7.7% of auto loans transitioning into delinquency on an annualized basis. That's not great, but we'll ignore that portion for a moment. Let's go to the actual banks, and let's understand what the banks are saying, because this whole video is based on the premise that the banks are lying through their teeth to us. Now, you might be thinking to yourself, but Kevin, the banks always lie through their teeth. How is that a surprise? Fine. But this is even more blatant than I've ever seen before. And that is what gets scary. Now, first, you have to know something. When it comes to banks, there are these things called provisions for credit losses. That sounds complicated, but it's basically kind of like doing this. You and your girlfriend sit down and you go, hey, honey, we're going to have to put some money aside just in case that water heater blows. And we think that water heater is going to cost us $2,500 to install because we don't know a good plumber, so we're going to get ripped off. We need to set aside $2,500 for that water heater. Okay, honey, well, we'll set aside $200 a month for it, and then we'll have nearly $2,500, and we'll just cut out some of the Christmas expenses, and then we'll have $2,500. Okay, we'll get to it. Okay, so that's a way of setting up an allowance for an expense that you think is coming. With the banks, you're actually allowed to lower your earnings by taking a write-off for losses you think you're going to incur. But if you just happen to think everything's going to normalize and be okay, I guess you don't actually have to take those losses. And you could use that to sort of manipulate your earnings. Now, that would only be concerning if some other numbers were getting really bad, right? Like, how about charge-offs? Okay, well, let's see what's going on with credit losses versus charge-offs. So credit losses are you saving for the water heater. A charge-off is kind of like, this schmuck owes us $1,000. He's never going to pay. Let's just write him off and get him out of our life and forget that he owes us $1,000. That's a charge-off, okay? So let's see what happens between the two. Ready for it? You'll see exactly what I'm seeing, and it ain't pretty. First, JP Morgan. Okay, what does JP Morgan have for us? Well, I want you to see this. The provision for credit losses is plummeting. Look at this right here. $2.7 billion of our credit losses provisioned in the fourth quarter of 2023. But then you go over here to Q1. Hey, we need to pump up that net income. So let's take fewer credit losses. We'll take 1.8. Nobody will notice that we just propped up the numbers by $800 million, which, wow, that $800 million is exactly what we need to show a year-over-year growth number. Literally, the difference in net income between Q1 23 and Q1 2024 is $800 million. Oh, shucks. We are growing, honey. We're doing great. Or you're lying to yourself. That's JP Morgan. But wait, it gets worse. Let's look at the trend of charge-offs. So remember, these are people you're saying, hey, schmuck, I'm not going to get any money from you. You suck. I'll take the loss. Q1 2023, and we're going to go quarter by quarter here. You ready for this? Card services charge-offs, $922 million, $1.1 billion, $1.2 billion, $1.4 billion, nearly $1.7 billion. Add up the totals, same thing. We literally increased charge-offs from $1.0 billion to $1.8 billion. That's an 80% increase year over year in charge-offs. So you're literally saying, hey, schmuck, you suck. I'm writing you off 80% more than you were at the start of 2023. Let that sink in for a moment. But wait a minute. What about card services net charge-offs? So for card services, we literally just went from 2.07% charge-offs to 3.32%. So we just increased those charge-offs 60%. And what's their response in their earnings call? Their response is literally, we continue to expect 2024 card net charge-offs to be below 3.5%. So think about that for a moment, okay? Charge-offs went up 60%. And on the earnings call, when they're asked about it, they're like, well, we continue to think it'll be below this extremely high level. And don't mind that the trend is skyrocketing. Nothing to see here, but we're doing buybacks, and don't mind that Jamie Dimon is selling. Okay, now maybe that's just a fluke. Maybe that's just a fluke, and maybe they're not lying to us. Oh, but wait, there's more. I'm telling you, by the end of this analysis, you will want to be with the 1,000 people that were in our live course member live stream this morning, understanding how to trade this market and analyze the crap that's going on. You pay once, you get lifetime access, need a bundle coupon, email us at staff@meetkevin.com. So what do we have right here? Wells Fargo. Net charge-offs were stable from the fourth quarter. Oh, well, that sounds good, Kevin. Doesn't that violate what you just said? Wait for it. Net charge-offs were stable from the fourth quarter. And we repurchased $6.1 billion of common stock, so nothing to worry here. We're buying back stock. Okay, great. So I go deeper into your financials. What were your charge-offs in the quarter ended Q1 2023, so last year? Oh, $564 million. Okay, $564 million. What were they now? Oh, $1.1 billion. Wait. So your charge-offs are up 105% from Q1. But don't worry, folks. We're stable compared to the fourth quarter. Stable bad. You're like stable at double, more than double what you were last year. Okay, that's not great. But look at this beautiful buyback. Oh, and don't worry. We made the provision for credit loss number look smaller in Q1. The way we were able to do that is we took our net charge-offs, and then rather than taking an allowance for credit losses, we actually gave us a smaller allowance for credit losses, which is kind of like taking earnings back, like basically giving ourselves earnings. So we gave ourselves $219 million, and now we're able to say, hey, look, our total provision for credit losses were actually less than what they were last year because we just manipulated the books right in front of your face and nobody said anything. I'm joking because the level of bullshit here is massive. And we're about to get to the earnings call where you'll see some more bullshit. But before we get there, let's go to Citi. Oh, okay, what do we have here? Citigroup cost of credit was up approximately $2.4 billion in the first quarter of 2024 compared with $2 billion in the prior year, primarily driven by higher credit cards net credit losses, partially offset by a lower allowance for credit losses. Wait a minute, what? Oh, okay, your reserve for that water heater, you normally grow that reserve by $241 million or $397 million. How much did you grow it by this quarter? $21 million. In other words, you barely grew it. While at the same time, what happened to net losses? Oh, last Q1, $1.3 billion. This Q1, $2.3 billion. A 77% increase in credit card charge-offs at Citibank. That's 3 banks in a row. Then, of course, we saw Jamie Dimon sell. But wait, folks, there's more. What did Wells Fargo tell us on the earnings call? Okay, so their earnings call, they get asked, what are you guys thinking for a peak in net charge-offs? Smart analysts. You want to hear what the senior vice president over at Wells Fargo says? And keep in mind, there's salesy stuff in between this that I realize is very salesy. It is more bullish. They're saying, look, everything's performing on top of what we would have expected. Maybe we're even doing better. Credit quality looks good. Things seem to be good. Great. That's really bullish. But what did they actually also write? And that's what I want you to pay attention to, and you have to sort of evaluate that yourself, okay? I just want you to read this red for a moment here. We're seeing faster growth in new accounts and new balances coming on. Okay, well, that's half bullish because it means Wells Fargo's growing, right? But it also means people are taking on more debt. Okay, that's not great. So we got to do some reading between the lines here, right? Then listen to this. At some point, charge-offs should peak, and you'll start to see some normal behavior. Then we go bullish, 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 right? Because they're like saying, hey, we spent a lot of time looking at the underlying things. We think things are going to, like, they're part in their normal phase of maturation. We think things are normalizing. And then listen to this line. And as it peaks, we'll sort of let you know when we feel like we're there. But it should be peaking over the coming quarters. In other words, we have no idea when these charge-offs are actually going to peak, but it should be peaking soon. And as soon as we have more clarity on when the numbers are actually going to peak, don't worry, we'll let you know too. But in the meantime, we'll be dumping our shares. Folks, welcome to Finance in America. Ooh, burn. That sucks. I'm shocked. I just want to be transparent here. And maybe I shouldn't be shocked that the banks are lying, but this is blatant. This is like blunt lying. Now, hey, maybe everything's fine. Maybe everything's going to be A-okay. But let's just say it doesn't take many straws like Iran-Israel combined with this sort of weakening at banks to make me really grateful I've got some more cash on the sidelines. Now, some people like to say things like, oh, well, you're just trying to find a bearish point of view to reiterate why you're in cash. I don't think so. See, I went to cash early March. I wish I went to cash a little bit earlier because that's when we really started seeing some red flags. I've been bullish since the end of 2022. I started an ETF around that time, and I've been pretty bullish. Inflation was going away, it was falling, everything was going good. Now, it's possible that everything that we had in the boom of 22 and 3, in terms of like, oh wow, earnings are beating in 23 over the 2022 hole, right? The pain of 2022 and the transitory inflation. It's possible all of that was just fugazi, backed up by, who knows, excess savings or whatever. And now we got to pay the piper, or as von Mises says, we got to clear out the malinvestment. That's not good. So, did the bad data and the bad indicators come first, or did Kevin being bearish come first? Well, I think the bad data came first. Now, I wish I went bearish first. I wish I could take credit for that. But let's just be real. I'm using the data to try to be bullish, to justify why I should take the risk and leap of faith of buying stocks right now. And I'm looking at it and going, oh, maybe I need a little bit more cash on the sidelines than... It's not good. So, yeah, I'm optimistic about two things right now. An expiring coupon code on Friday. Email us at staff@meetkevin.com if you have a bundle code request, which you can bundle up with our event in June. It's going to be a big event, about to announce some really major speakers, so the price will be going up after we do that. And of course, get yourself life insurance in as little as 5 minutes by going to meetkevin.com/life. Paid promotion, but both Lauren and I use it, and it's great. Never had a problem with it. See you soon.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.